Hello and welcome to Vox Markets. I am John Human and I am delighted to be joined today by John Rosier, the esteemed blogger who runs John's Investment Chronicle and one of the leading lights of the private investor community. We're going to talk today about John's. Don't be coy, John.
Thank you, John.
How are you doing? How are you doing?
All right, thank you. Yeah, good to chat again.
Excellent. Yeah, it's been a while. I think the last time we actually properly chatted about your portfolio was pre-pandemic.
It was, I think, yeah, November 19, wasn't it? And
crikey.
Yeah, we didn't know what was coming around the corner.
No, we certainly didn't. And it's going to be great to hear how you fared through those, tumultuous. Well, it's nearly 3 years, I suppose. But before we do, I think the best place to start is if you introduce yourself and John's Investment Chronicle. Tell us what you do, how you came to do it. It's been going quite some time now, 135 months, I think you said.
That's right.
Your last piece.
Yes, yeah. So I started in January 12, and the whole idea of it was from, I'd been running my own money for a year or two before that, and I'd used various sort of websites and tools to get information, and I just came up with the idea of doing John's Investment Chronicle. And the idea behind it was just say, here's a chunk of cash, and I will talk about how I invest it. It'll be very transparent, so you'll always see the portfolio. Whenever I make a change, do a trade, I will basically show the contract note and inform people who follow my website within 15 minutes of the trade and explain why I've done it. So in effect, my sort of members are my auditors, because I can't, if I buy a stock that the next day there's a profit warning and it drops 30%, I can't pretend I didn't do it. It's there in the portfolio, and I've got to deal with it. So really, it's taking my members on my investment journey, and just trying to be sensible. I'm trying to make money long, over the medium long term, not lose too much, in downturns and things. But basically just trying to build wealth over a long period, compounding up.
Yeah, I mean, it's worked so far. The performance since you started has been way ahead of the benchmarks. Yeah,
I mean I think the annualized performance up to the end of March, so it is 135 months, 11 years, 3 months or whatever. The annualized was 13.2. And over that same period, the all shares 7.2% annualized, including dividends and everything. So, yeah, I'm happy with that, but I'm not so happy with the last sort of 21 months, because it's actually 21 months since the portfolio hit a peak, and I'm about 13 and a half or so below that level now. So yeah, it'd be nice to hit a new peak at some stage.
Well, I'm sure you were, as you say, it's a long-term journey, and I think it's been a horrible period for lots and lots of people. We'll come on to sort of how you manage the portfolio. There's a second portfolio that you run as well, which I find quite interesting. So the main portfolio is a mix of funds and equities, but you've got a funds-only portfolio, which is quite interesting. Talk a bit about that. Why you put that together as well?
Well, I started that on the 1st of July 2020, and that effectively is my wife's SIP. So she'll have to tell her she'll be working for a few more years. Anyway,
tough client.
Or she won't be taking a pension anyway. But that was launched, and the idea was just to invest in funds. I came up with the idea because occasionally I lost the odd member from my website, and often you say why, and they'd say, well, I just don't have the time or inclination to pick individual stocks and things, and I just want to invest in funds. And I thought, okay, that's a good idea. So I launched that, and actually it seems quite popular, actually.
Yeah.
I've got about 12 different portfolios, and again, I'm trying to make that into a sort of do little portfolio, so not chopping and changing all the time. So it's got things like Fundsmith in there. That's around 10% of the portfolio and things. So just trying to pick some good, mainly investment trusts and the odd other fund. So in the UK, for instance, my main UK exposure is through something called Chelverton UK Equity Growth. And, you know, the disadvantage is it's obviously it's a fund, so it's not an investment trust, so I can't play the discounts or whatever. But the performance is just fantastic. I really like the manager's approach. You know, I first met him probably about 6-7 years ago, went to a presentation, and just like the way he approached everything.
Yeah, there are some great managers out there, and it's as you say, it's good to provide that sort of different type of approach, the hands-off approach for the people who, as you say, don't necessarily have the time to be as enthusiastic about equities as some of us. And you know, you are busy. This book, I mean, go on the site; it is incredibly detailed. You know, every trade is there, and you know, it's an incredible amount of information. Must keep you very busy.
Yeah, well, it's I mean, it's quite. People say, how much time do you spend on it? And I don't know. I probably spend. It varies from week to week. But I mean, the one thing I'm at my desk ready at 7 o'clock every morning, because if there's an announcement. So yesterday we had Serica Energy, which is it's my second largest position, and they came out. You know, I wasn't expecting it. They've got results next week, but this was just basically an update on their reserves. And what you had, the situation there yesterday, was at the 31st of December 21, they thought they had reserves of 100 odd million, 104, and they've now been upgraded to 130 million. And anyway, the share prices was up 3% odd yesterday. It's up 1.5% today. I mean, logically, it should have gone up 20-25% or something. Logically.
Yeah, it's a funny old market though. There's no logic. There doesn't seem to be a lot of logic about it anywhere at the moment. No. I mean, it's interesting. We'll come on to the sort of the specific exposure that you have in your portfolio. Commodities is big, and as you say in your last review, which you can find on the website. And in the Investors Chronicle as well. It's published there as well. It's been a sort of a blessing and a curse over the past year, that commodities exposure. But let's talk about your style. So how do you invest? I mean, you know, in this last piece, I think you talk about, in some senses, taking a top-down approach and in others, a bottom-up. You talk about how you manage that balance.
Okay. I prefer to be bottom-up, ultimately, to find stocks where there's good value. So I've quite a value approach. You know, I feel more relaxed about buying stocks on 12, 13, 14 times earnings than stocks on 24, 25 or whatever. Because ultimately what you're looking for, I think, is the sort of double whammy, where you start with a reasonable or low valuation or a reasonable valuation, but then the earnings growth starts to be much quicker than the market, maybe earnings upgrades. That's even better if you get the earnings upgrades come through. So you then get people take notice of the company and then they revalue it. So you're not only getting a revaluation upwards, but you're also getting it on higher earnings. So that's the sort of thing I'm looking for. I mean, some of the stocks I've bought this year would be good examples. I mean, I added Me Group, the old Photo Me.
Okay.
The portfolio. And that to me is just a classic sort of compounder. It's valued on not much more than 10, 11 times earnings. It's got a good yield, 5% yield nearly, and yet return on capital of 25%. So it's generating loads of cash, and it reinvests some of that cash into building its estate and modernizing, the machines and upgrading the machines, etc. But it gets a great return on that. And then there's lots of cash left over, and that cash comes out in special dividends, share buybacks, etc.
Yeah.
So that to me just looks really cheap. But even if it just stays at the current valuation, you're just going to keep getting a good dividend increase and a good dividend out of it.
Yeah, that was a question I was going to ask you actually. How important are dividends to you in money?
Okay, well, that slightly varies. At the moment, they're really important to me. In that, I think we're going through a stage where value is going to do better. A bit like the early 2000s. when we came off, the dot-com boom and everything. And, growth had been the growth at any price, just let me have growth. And then obviously from sort of March 2000, everyone piled out of that and they piled into value. And that, value had a good run. I mean, it was 4 or 5 years. It's not just something that happens for 6 months. And given the uncertainties about, we could argue about, is the US going to go into recession? Does it matter if it goes to recession? The Fed, if it starts, well, already it's increasing liquidity. I mean, quantitative easing is back. So you can look at all those sort of things, but, and I don't know the answers, but so I think it's best to stick with stuff where the balance sheets are pretty strong, net cash, paying decent dividends, and you can feel reasonably comfortable about the earnings outlook. So at the moment, I'm big into my dividends. Yeah.
So how do you go about researching companies? How do you find these new ideas? What sort of process do you go through to find potential candidates for the portfolio?
A lot of reading. I'm just reading lots of things, looking at other people's ideas, and then looking at it and thinking, okay, so why are they buying that stock? And just doing the work, going. So you start by the company website, looking at all the information they're giving you. You read the report and accounts. You can then look at past news updates from the companies, whether it's trading updates, results, see what they're saying in there. Then there's things like research tree, so you can get hold of some brokers' notes and get a bit more detail from there. So, but with a lot of companies, I'll look at it and it'll take me 1 minute. I'll go on Stockopedia and I'll just look at it and I'll go, I don't like it because the valuation doesn't look that attractive. I don't like it because it's low margin business. I don't like it because it doesn't generate much free cash. I like free cash flow. So a lot of my stocks are generating a lot of free cash flow. Yeah. So you can dismiss quite a lot of ideas within a minute or two. And then you drill down into the ones that actually that looks interesting. I can see the potential there.
Yeah.
I love stocks. Here's a good example. There's 2 stocks recently. So Bloomsbury, they are a March year end. They came out with, February year end. They came out with a trading statement in the middle of March. I just knew that was going to be a good trading statement. And the reason I knew it was going to be good is because I looked at the half on half, year figures. And if you looked at their first half and the growth in the first half, and you then, over the first half the year before, you then compared it with the forecast for the full year, basically, the consensus forecast, you'd have had to have had an absolutely flat second half for them. And given what they said at the half year in terms of the growth in the business and how trading was going, you just knew there wasn't going to be. So they came up with this trading statement, consequently earnings upgrades by 15%, and the shares go up. Now, I think when the results actually come out, there'll be more upgrades for the current year. So another stock that I hold, and I've held now for 8 years, is Bioventix. They had their half-year results the other day. In fact, they went ex-dividend today, 62p, 20% increase in the interim dividend. Very nice. But they, I looked at the broker's forecast for the full year. It's a June year end. And again, there just have to be no growth in the second half. And you've only got to read their trading their statement with that things are going well. So I know that when those results come out later this year, there'll be big upgrades.
Yeah. So it's common sense, basically.
Really, common sense
and a bit and good old fashioned hard work.
And looking at half on half year results is fantastic. I've been doing that for years.
Yeah.
Because then you can look at the full and just say, no, these earnings forecasts are too low.
Yeah, simple trick. We like those. I mean, you're talking about the bottom up side of things. You mentioned in your latest monthly commentary that you've actually sort of been thinking a bit more top down in terms of sort of the macro picture, particularly around the commodities, which, as I say, you've got a pretty big exposure. Can you talk about how that sort of that top down thinking has sort of, you know, made its way into your portfolio, particularly around the commodity space?
Okay, it started really in sort of second half of 2021. That's when I started really building up a commodity. So BlackRock World Mining is my biggest exposure. But then after that, I've got other things like Sylvania and Serica Energy we talked about, Ecora Resources, which is a royalty company. Basically, gets it. You know, it invests in new mines, etc., but for a royalty payment. So part of the reason for getting involved in it is this energy transition. So, you know, global warming's happening. Money is going into you know, renewable energy, electric vehicles, all these sort of things, and it's just going to need a lot of copper, manganese, nickel, cobalt, lithium, and far more than there is supply, you know, in the short to medium term. Against that, you've also had commodity companies being disciplined about capital, and also you've got sort of ESG concerns. So actually opening a new mine is very difficult compared to the past. So all these things are conspiring. And again, I do a lot of reading. I mean, Wood Mackenzie up in Scotland, you know, the consultants, they produce quite a lot of work that is free if you want to read it. And you can just see what's happening with copper. And so basically it's a price-driven thing. I think the price of these commodities will go up. Now, listen, this all worked for me during 2022, but it's not worked this last quarter. So it probably hit my performance by around 6% or so, just the exposure to commodities in the first quarter. And I guess the reason is people are worried about the economic outlook around the world, US going into recession. Now, again, I don't know what sort of impact that'll have, but you've got Biden with his Inflation
Reduction Act, yeah,
whatever, which
huge.
seems an extraordinary way of, yeah. But anyway, that's huge. The amount of money that's going to go into the spending on renewables and wind farms and solar, etc. So I you know, hopefully they'll start to perform better. In the meantime, you know, things like Glencore are paying me a 9% dividend yield.
Yeah, back to the old dividends.
So I'm not going to give up.
Yeah. I think it's really interesting though. You know, and I love this diary approach. You know, I guess you must learn a lot about yourself as you do it. There's a paragraph in this month's one that said my approach, and you're questioning yourself about these things. I love that. I mean, it's, you know, diary investment diary keeping. Do you think it's something all investors should do? It must.
Yes.
Self-reflection.
But it is. It's just useful to start with, because you can often look back at it, because you click on a company, you can see everything you've written on the company from 3 years ago when you bought it, and you just can remind yourself, when I bought it because this was the premise, this was the valuation, and you go, and this is what I was expecting. You think, yeah, well, that has happened, but look at the valuation now. You know, when I bought it, it was on 11 times and whatever. Now it's on 18 or 19. Maybe there's something better where I can move that money into. So it is useful having that history you can go back and look at. But also, I mean, the point, you've got to look at whether if you're going through a sticky period, I think you've got to look at it and say, why? Why am I going through it? Have I changed my style? And the question I ask there is, have I become, you know, that balance between bottom up and top down, had I got a bit too top downy, you know, and not enough of the bottom up? And maybe I had slightly. And that's why, you know, at the beginning of this year, I tried to get some new life into the portfolio, and actually they've worked very well. You know, I added Shoe Zone, IG Design, Me Group, and Bloomsbury. So 4 new holdings, not in commodities. And, you know, so far on IG's up 28%, Shoe Zone 11, Me Group 4, and Bloomsbury 8. So, yeah, pity I hadn't got a bit more of those sort of things. But anyway.
Yeah, Shoe Zone. It's a really interesting company, and it, you know, retailers had a torrid time as a sector, but Shoe Zone's really been the standout there.
Yeah, I remember when I bought it, one of the chaps sent me a message saying, "Have you ever been in a Shoe Zone?" I said, "Well, yes, I have. You know, I've been into the one up Morecambe, and it was packed, and you know, people were buying cheap shoes." But I mean, I think they've done well. I mean, obviously they get hit like everyone else by COVID. But I think they're really benefiting now because there's 2 strands to it. I mean, obviously, trading down won't do them any harm. They've also got sort of new style stores, which they're sort of rolling out, where they're getting a good uplift in margin. So, because, you know, you can buy some brands, you know, in Shoe Zone as well, some reasonable brands and things. So they're getting a bit of an uplift in terms of mix and brand.
Then the shift to the big box format, isn't it? From the smaller form high street stores. Yeah.
And then the other side to it is really the property side, in that they have pretty short leases. I think it's under 2 years on a lot of these things. So what they're being able to do, and you see, they're not prime high street. So what they're being able to do is actually get much better property deals, either because, you know, the landlords at the moment, you know, it's difficult. So landlords maybe will give them a better deal, and if the landlord won't, then they can just move you know, a quarter of a mile up the road to somewhere where they can get a better deal. So those costs are coming down quite nicely as well. So they're generating loads of cash. They paid just recently an ordinary dividend of 3p, I think it was, 3.3, and a special dividend of 8.2. They've been buying back stock. They just announced last week another 3 million buyback, which suggests to me that, you know, trading's going all right at the moment. They're still generating cash. So I'm looking forward to the next results from them and see, you know, what the state of the balance sheet is.
How's the valuation looking on that one?
You know, what are they on at the moment? Let me just check my thing here where I've got the. So you have got. All right, so the PE for the current year ending October on forecasts is 18 times. So, you know, that you might think would be up to a thing, but I just think the earnings are far too low. I memean, basically in October, there were big upgrades. Earnings were upgraded from around 11p up to 13.5p. With you know, with the results. So I think you're going to see more upgrades come through, which will bring that rating down.
Yeah, no, it's a great company. It's a great company. Tell us about the fourth company you added have added this year, IG Design. This is greetings cards, if I'm right in thinking.
Well, yes, all sorts of sort of. I mean, it's about 70% US through acquisitions they made in back in the late teens. I remember meeting them in about 2019 and was really impressed with management, but I thought it looked too expensive because it had an amazing run. It'd been a fantastic stock to be invested in, but I just thought it looked too expensive. So I'll put it on the watch list and come back and look at it. Thank God it stayed on the watch list and didn't come off it, because it then just, I mean, it got hit by COVID, but also I think they weren't fully in control of the US business that they'd bought. Anyway, eventually you got new management come in. And if you go on the website, and also PI World did a really good interview with them last November, I think it was. It's really worth watching, because I think the management team come across are very impressive team, and they're just doing all the right things there. So you've got thousands of SKUs that they think they sort of have rationalized that down to working out where they were making money and where they weren't making money. So getting rid of a lot of that, sorting out sort of working capital. One of the big problems they had in 21 was a lot of increasing costs and delays, because a lot of the stuff comes from China and the Far East, etc., into the US. So there were delays, and they couldn't supply, their customers and things. So they've really got on top of that. And the latest news from them was back in November. And big upgrades to earnings then. I mean, I think it became very clear that all the sensible things they were doing were coming through in improved results. And then we should hear from them, I think, at the end of this month. You should get a sort of trading update, a full year trading update. And hopefully then more upgrades. Again, on Research Tree, there's some notes on there. I mean, looking out 2 years, you sort of take things with a pinch of salt. But I mean, I think it's on about 6.8 times the earnings. If you look out to March 2025. Now, look, that's further away. But I think that shows what they can do. If they keep delivering. I mean, it used to be a business that had decent returns, reasonably decent margins. And so they've just got to get those margins back up. So it's sort of, I think, more of a margin story than a sort of sales top line growth story at the moment.
Yeah, sort of a classic value play, in fact. A classic value play.
Yes. I mean, I've tried the odd recovery play before. Like I bought De La Rue a few years ago, and that was a complete disaster. Luckily, I cut it in January last year, and it's about 30% lower than when I cut it. But I think with this one, I'd waited. Yeah, no one could say I was early to the story because the share price had moved up quite a lot in the last 6 months. But I certainly waited till I think there's clear evidence that a new and capable management team were delivering. The risk was less, I think.
Yeah, absolutely. Well, we can see all of your winners and losers on your site. There is no hiding there.
No.
De La Rue, I did notice that one. Yeah. It's all kicking off there at the moment. So you probably got it. So I mean, when you do cut, what makes you decide at a given point? It's like, right, I'm out of this one.
You know what? It's still the bit I'm not good at. It's so difficult. And I know some people just have automatic rules like 20% cut. But, I can point to, I don't know. I don't like doing that because I think unless something has changed, then the stock's just 20% cheaper. So you actually should be buying more.
And do you buy more at that point?
Yeah, I have. I mean, things, a lot of stocks you can see, and I often point to, if I'd had a 20% cut rule, I would never have added to that stock here and that stock there, which is now carried on. So I think you've got to look at everything on its merits. If the story has changed for the worse, then maybe that's, you've got to look back. Why did I buy it? Is that premise still in situ or not? And if it's changed, maybe management aren't delivering or whatever, then you need to cut.
Yeah, really go back.
The last stock I cut was IOG, and that was a terrible purchase. But I look back, I think why I bought it was fine. Luckily, I didn't have too much in it, but I should have cut far sooner.
But you can't win them all. And the performance suggests you win more than you lose. So just to wrap up, I mean, we've talked about some of your recent buys. What are you looking out for at the moment? What's on the watch list?
Oh God, watch list. I mean, also, I don't know. Well, I've been looking at. I'm not going to say I'm going to buy it or anything, but I've been looking at Man Group. If you look at Man Group, you look at the forecasts, generally people don't write in performance fees into forecasts. They don't include them. And yet if you look at Man Group's history, their performance fees have been fairly consistent. And I don't see any reason why that might change going forward. It's got a nice yield on it. That's quite cheap. They're very good at what they do. They invest a huge amount of money into their sort of scientists who work on all their computer algorithms and things. And you know, it looks an interesting stock to me.
Yeah,
just from the valuation things, but I need to do more work on it. And also, you see, at the moment, I'm fully invested. We're 1.9% in cash at the moment. And obviously, to buy something, I've got to sell something. And, you know, so it was quite a good discipline. I can't just find a few thousand quid from here and shove it into Man Group unless I sell something in the portfolio. And at the moment, I quite like everything I hold.
Excellent. That's good. That's a good place
to
be.
Yeah, I spend hours.
Good place to be.
Yeah. Wish some of them perform a bit better, but they're starting to. It's nice to see some of those commodities doing a bit better this quarter, but fingers crossed. See, the oil thing helped the other day, the oil price jumping.
Yeah.
You know, that's been volatile. It was a couple of weeks ago at $70 Brent crude, and now it's, what, 84 odd.
Yeah, no, it's a great portfolio. I mean, it really does have a really nice balanced feel to it. And if you want to actually have a look at it, is it John's investmentchronicle.co.uk?
Well, no, it's I simplified it.
I
found that well, it used to be John's Investment Chronicle.com, and people, you know, you told someone that in the evening, the next day they've forgotten. So it's now JICUK.com. JICUK.com. And there's free trial nowadays. I introduced that. So 2 weeks free trial, don't have to pay anything. And what else? Yeah, no, that's the main thing. Free trial. Yeah. Also, there's a new page literally I've added this week where there's a few example blogs. So what I put on that were the reason I put these sort of 4 blogs when I bought, you know, Bloomsbury and IG. So you can read why I bought them, but they're back in January, so they are a few months old and things have moved on.
Yeah, but, it's well worth a look. There's a wealth of information in there, and as I say, it's really, really good to see a process, an investing process in action, and perhaps it's something that all investors can try and emulate that reflection. It's fantastic. Been fantastic speaking to you, John, and I hope we catch up again next month.
Good, lovely. Thanks a lot.